Taking care of a loved one with a disability, it's just an incredible act of devotion. But let's be real, it comes with some pretty hefty emotional and financial costs. The medical bills, the specialized training, the everyday rehab, it all adds up, and it adds up fast. So today, in this explainer, we're going to unpack Section 80DD of the Income Tax Act. Now, this isn't just your standard run-of-the-mill tax code. It's actually a highly specific relief mechanism that the government designed specifically to ease the financial burden on caregivers. But like literally everything in tax law, it has some very strict rules. If you don't know exactly how to navigate them, you might be missing out on some really substantial relief. Okay, let's dive into this. Here's our roadmap for today. We'll be looking at Section 80DD Basics, defining a qualifying dependent, identifying qualifying payments, the quantum of deduction, and finally, we'll run through some illustrative tax scenarios.
All right, first up, Section 1, Section 80DD Basics. Who is eligible?
So, let's establish the absolute foundational rule. Who is actually allowed to claim this deduction? Section 80DD is specifically available to resident individuals and Hindu undivided families, or HUFs, right here in India. But wait, there is a massive catch, like a total game changer. This deduction is completely unavailable to you if you stick to the new default tax regime, which is legally known as Section 115 BAC1A. To claim Section 80DD, it is absolutely mandatory that you exercise the option to shift out of the default regime and pay your tax under the normal optional provisions of the Act. If you forget to do this, man, all the caregiving expenses in the world won't unlock this specific deduction for you. Moving on to Section 2, defining a qualifying dependent. Who counts? Assuming you've got your tax regime sorted, we now transition into the strict legal boundaries of the law itself. Because the tax department, they don't just let you claim expenses for anyone you happen to be helping out. For an individual taxpayer, the law restricts dependents strictly to your spouse, your children, your parents, and your brothers or sisters. For an HUF, it can be any member of the HUF. But look closely at those two vital conditions. First, the person must be wholly or mainly dependent on you for their support and maintenance, meaning you can't just chip in a few bucks for a wealthy sibling's medical bills and claim the deduction. Furthermore, the dependent person cannot have claimed a deduction for themselves under Section 80U. Basically, it's either you claim the caregiving deduction under 80DD or they claim the disability deduction under 80U. No double dipping allowed, for sure. Let's move to Section 3 and see how this builds. Identifying qualifying payments. What is deductible? Okay, now that we know the who, we really need to focus on the what. What exactly does the government consider a valid, deductible expense for your dependent? The law essentially splits eligible payments into two main avenues. First up are your direct, out-of-pocket expenses. This covers the actual money you spend for medical treatment, including nursing care, training, and the general rehabilitation of your disabled dependent. The second avenue is a bit more forward-looking. You can also claim the deduction for amounts deposited under specific approved schemes, like those from the Life Insurance Corporation or other approved insurers that are specifically designed for the maintenance of a dependent with a disability. Now, it wouldn't be Indian tax law without some paperwork, right? To actually prove you're eligible, you have to furnish a valid medical certificate. And this has to be issued by a medical authority operating under the Persons with Disability Act of 1995. You've got to submit this document right along with your tax return. Without this certificate, your claim simply won't stand up to scrutiny. Section 4, the quantum of deduction. How much? Now, what's really interesting about this slide is how it breaks from the norm. Usually, tax deductions mean saving every single receipt and claiming exactly what you spent. But Section 80DD operates totally differently. The law provides a strict two-tiered system for relief based entirely on the severity of the disability. If your dependent has a normal disability, the deduction is a flat 75,000 rupees. But if your dependent suffers from a severe disability, that flat deduction jumps up significantly to 125,000 rupees. And just to be absolutely crystal clear on the definitions here, the law defines a severe disability with a very specific metric. It strictly means a person suffering from 80% or more of one or more disabilities. That is the exact legal threshold you have to meet to unlock that higher 125,000 rupee tier. Okay, this next point is basically the major aha moment of this entire explainer. Section 80DD does not just reimburse your expenses, it gives you a fixed statutory flat rate deduction. This means the deduction is allowable totally irrespective of the actual amount you spent on maintenance or deposited with the LIC. Whether you spent a little or a lot, as long as you incurred a qualifying expense for a qualifying dependent, boom, you get the full flat rate deduction for that tier. And this brilliantly illustrates our final section. Section 5, Illustrative Tax Scenarios, putting it into practice. Theory is great and all, but let's see how these strict rules actually play out in the real world. We're going to run through a quick mini quiz using scenarios straight from our source material. Here is our first scenario. Let's say Mr. X is a resident individual. He lovingly deposits 50,000 rupees with the LIC every single year for the maintenance of his disabled grandfather, who is wholly dependent upon him. Mr. X has the medical certificate and he's opted out of the default tax regime. So does he get the Section 80DD deduction? The verdict? Actually, it's not allowed. Zero deduction. Why? Well, because tax law doesn't really run on sentiment, does it? It runs on strict definitions. The law explicitly lists spouse, children, parents, brothers, or sisters. A grandfather, no matter how beloved or dependent, simply does not fall within the strict legal meaning of a dependent for an individual under Section 80DD. Okay, let's instantly pivot that scenario. What if Mr. X took that exact same 50,000 rupees and deposited it under an approved scheme for his dependent disabled father instead of his grandfather? Yes, in this case, it is completely allowed. Because parents are explicitly defined as eligible dependents, Mr. X unlocks the full deduction. And remember the rule we talked about. Even though he only deposited 50,000 rupees, he gets the flat deduction of 75,000, or a massive 125,000 if his father's disability is classified as severe. Let's look at one more scenario just to really lock in this kind of counterintuitive flat rate concept. Imagine a taxpayer named Varun. He deposits just 25,000 rupees for the maintenance of a qualifying dependent disabled person. What is the exact amount he can deduct from his gross total income? Take a look at this. Varun spent 25,000, right? But he is legally entitled to claim a 75,000 rupee deduction. Now compare him to Rajan. Rajan spent 45,000. His deduction? Exactly the same, 75,000 rupees. This right here proves the incredible power of Section 80DD. As long as you spend or deposit any qualifying amount for an eligible dependent, the law generously grants you the full flat statutory deduction. Which brings us to our final thought for this explainer. We've seen just how powerful Section 80DD can be. It offers a guaranteed flat rate deduction that can significantly lower your taxable income if you're out there caring for a loved one. But, and this is huge, all of this incredible relief hinges on one single administrative choice. If you just default to the new tax regime, all of this vanishes. It's gone. So the question you really have to ask yourself or your accountant is simple. Are you leaving crucial tax relief on the table simply by staying in the default tax regime? It is absolutely worth doing the math.